Now, you've been told to max out your 401k and invest in stocks probably, but is this the best way to build real wealth? Or is real estate the better path to financial freedom? Well, most people, including myself when I got out of dental school, they follow the traditional advice and stay stuck trading their time for money. But some use a different strategy to retire much earlier. And in this video, I'm going to break down what actually works, stocks or real estate, so that you can decide which one builds true wealth faster. Now, before we get into the pros and the cons, let's get clear on what we're investing in, okay? Stock market, okay? You're buying a share of a company, meaning your wealth is going to depend on the stock market performance. Stocks are also very easy to buy and sell. Literally, you can go on your phone with the click of a button. And then stocks, no control over value fluctuations, right? Because your money, when you buy a stock, is basically at the mercy of the market. Now, let's talk about real estate. There's different types of real estate out there, but no matter really what you buy, you're buying a physical asset, rental properties, mobile home parks, RV parks, apartments, that sort of thing. It generates cash flow and typically goes up or appreciates over time. And then you can control how it performs through better management, make improvements, financing, that sort of thing. So the key question is this: which one actually helps you build wealth faster? Let's compare. So let's start off with stocks. Now, I want to start off with the pros of the stock. As I mentioned before, you can basically just click a button. So it's very easy to fund. Okay, you can buy them in the market with this little as just a couple of bucks. This is what many people like about the stock market and buying stocks. It's highly liquid, which means you can basically buy and sell at any time. So if you need money fast, you can go to your phone, Robinhood account or whatever, sell. All right. Historically, so we're going to put historically, I guess depending on what chart you read, but historically they have very strong long-term returns around, we could say, depending on which chart you read, anywhere from 7 to 10% on average. And then, as you know, when you buy a stock, it's very hands-off type of investing. There's no tenants to deal with, there's no maintenance. You can just go in, set it, and forget it. Now let's talk about the cons of buying stocks. What we'd stated before, you're at the mercy of the market, which means you have no control. The stock market is influenced by the economy, interest rates, and basically global events, what's happening in the world. Volatility. Stocks can be very, very, very volatile. Your portfolio, when I'm recording this right now, the Dow has dropped close to 3,000 points in the last 2 days. So your portfolio could literally drop 30 to 50% overnight in a crash. How would you feel if you had just retired a few months ago and you see 30 to 50% of your portfolio go away? Very volatile. No passive income coming in unless you have a dividend paying stock. So most investors, they rely on, you have to sell your stocks. If you're buying a mutual fund, you want to get that money out. It's not going to be passive. You have to, when you sell it, you're going to be taxed. And speaking of taxed, typically the stock market or stocks are heavily taxed. Capital gains tax. So that you don't really get a lot of tax advantages. And the biggest downside is that when you invest in the stock market, when you invest in mutual funds for the first 10 to 12 years, that's all I did in Vanguard, index funds, still have index funds, but they just don't generate any passive income. And you have zero control over the outcome. All right, so now let's do the same thing. Look at the pros and cons of real estate. Now let's start off with the pros of real estate. One of the biggest reasons that I invest in real estate personally, actually this morning I closed on my 8th mobile home park in Louisiana, is a cash flow. You get paid every month from your tenants through rental income. Number 2, leverage. What does that mean? Well, basically you can go like we did to the local bank and we can use the bank's money to buy real estate, to buy assets, which help you boost your returns because you're not using all of your money. Unlike stocks, real estate offers some tremendous tax benefits. The number one is depreciation. 1031 exchanges and cost segregation studies that can legally reduce your taxes to sometimes zero. You have depending on what type of partnership you're in, you have control over the value. What does that mean? Well, so for instance, we just closed on this mobile home park. Well, we're going to be increasing our rents. We can control the value of it now that we've increased the rent. We've increased the net operating income, which has caused it to go up in value if somebody were to turn around and buy it later after we increase the income. You can improve the property. You can force appreciation. You can do these things. You have control over bringing more value. And really ask any wealthy person out there, and they'll tell you that real estate is a wealth multiplier. Real estate values historically go up. They increase over time. You can refinance them. You can reinvest, and you can scale. You can really build this out. Now, let's talk about the cons. This isn't always true, but for the most part it is. It requires money. It requires capital. Unless you're able to go out like I am and you have a network of people and you can raise capital from other people. If you have a network of people that want to invest in your projects or invest in something that you're investing in, then you don't need capital. But typically you do need capital. Unless it's creative financing, you're typically going to need around 20% down to buy property. Compared to stocks, this is what a big hang up for people that don't want to get into real estate. It's less liquid. You can't just go out and just boom, sell real estate very quickly like you can with stocks. Third, active management. Unless you hire property managers, then you're going to be the one that's responsible for dealing with the tenants and dealing with the maintenance. And number 4, market cycles, they still matter. Just like the stock market has cycles, real estate has them as well. So values can drop in a bad economy, just like the stocks can go up and down. They can drop when things are going wrong. So for high income earners, doctors, dentists, that sort of thing, the biggest advantage, in my opinion, because I invest again in the stock market and I invest in real estate, the biggest advantage of real estate is that it creates passive income, pays you every month with massive tax benefits. Passive income with massive tax benefits. Some of it, if you do it right and you have a good accountant, literally you can have a stream of W-2 income coming in. So I have this dental income that comes in, and then you're taxed separately. Then you have passive income coming in that you pay very, very little to no taxes on. Okay? If you just W-2, if you just have your regular income coming in and you're investing in the stock market, you're having to rely your entire career on that active income. Again, they didn't teach me this in dental school, which is why I'm trying to teach this to you. So based on what we just talked about, stocks versus real estate, which one fits your goals? Again, this is going to be, I want to give you the option because your goals are probably going to be different than mine. All right? Let's talk about which one builds wealth better. Again, that depends on what you want. So if you want just easy investing and you really don't mind volatility, stocks work. If you want passive income, if you want leverage, if you want tax benefits, real estate wins. If you want both liquidity and long-term wealth, well then you may want a hybrid approach. Makes more sense. That's what I've done. Okay, so let's give an example. So let's go with the dentist. So we have a dentist and he is been maxing out his 401k for, let's say, 20 years. So let's say he got out, let's just make it easy. He was 30 years old. He's 50 now. He's been maxing out his 401k for 20 years. And let's just say he might end up with $3 million in the stock market. A lot of money. But here's the thing. He wants to tap into that. He's going to have to sell shares to live off of. Here's another thing. If he's 50, and again, this is in a 401k, well, he's going to have to pay taxes and he's going to have to pay fees. So let's just say that this isn't a 401k. Let's just say he has $3 million in index funds. It's a non-retirement account. Well, if he wants to access that money, he has to start to sell shares to live off that money. All right. I never really liked that concept of thinking about something going down in value, always trying to time, do I have enough money? Because we don't know. We don't know if we're going to die tomorrow or 50 years from now. You never know. But if you are investing in something that's on you to sort of just chip away at it, you got $3 million and, well, I don't want to what we talked about earlier, the stock market can go down 30 to 50%. Well, what if it loses $1 million overnight? Now he's got 2 million and he's got this lifestyle. So he's always having to look at that and worry about it and change his lifestyle. That never sat comfortably with me, but I didn't know how to do anything else. And that's why I do what I do and teach you what I'm doing. And then maybe you could do the hybrid approach. Okay. So you have this dentist that's doing it like this. Meanwhile, you have another dentist. So let's just say this is dentist A, and then we have dentist B, okay? And then he goes out and he buys, he can 5 to 10, 5 flowing properties. This could be single family homes, this could be duplexes, this could be mobile home parks, whatever. And this person goes out and he does that, and he's making on all the and passive income, not really paying any taxes on this, $20,000 he's accumulated in passive income, making that a month, and he's able to retire early without selling anything. You see the difference? So one person is relying on the market's ups and downs, which is probably your situation, while the other one has cash flow that's coming in, covering their expenses. And at the end of the day, both stocks, mutual funds, and real estate, they have their place. But only one is going to let you build passive income, use leverage, and let you keep more of your money. Again, I use the hybrid approach. Okay, what's best for me may not be what's best for you. I'm best in both the stock market with my practices retirement account. I've had Vanguard in funds, and then real estate, specifically RV and mobile home parks. Okay, that's what I do. So probably before you even start with, should I do stock, should I do real estate, get very clear on your goals. What do you want to accomplish in the next 5 to 10 years? Maybe because when you meet with an advisor, they're automatically, you're going to be working for at least 30 years. So they're going to goals for you. And when you talk about, well, maybe I only want to work for 15 years. Well, that's not going to jive with them. So again, having the hybrid approach for me works the best. And we've talked a lot about real estate. We've talked about mobile home parks, RV parks. I love investing in real estate syndications. So if you actually want to learn more about why I invest in real estate, then check out this video.